All right, in this video, we're going to walk through a problem involving accounting for available for sale debt securities. Recall, we've got three different classifications. We had trading, in which case we've purchased them with the intent of selling them in the near term in hopes of making a profit. We've got hold to maturity or held to maturity. Those are bonds that we have purchased and intend to hold until they mature, and we're going to get that par value back or face value back. And we're going to record those, of course, at amortized cost, and we're not going to report gains and losses. But we're talking about our available for sale, which falls right in between. We record them at fair value, but any gains or losses are reported separately in other comprehensive income. So again, report them at fair value. Unrealized holding gains are recorded, but reported as other comprehensive income, and then any premiums or discounts on our bonds are also amortized, as well as interest, recording any interest income. Let's work through a problem. We're told that the Shamrock Company purchased $80,000 of 6% 5-year bonds of the Chester Corporations. The bonds provide a 5% return. Ooh, check that out real quick, 5% return. So investors are demanding a 5% rate of return. These bonds have a 6% coupon, cash payment. So they're going to look like great bonds, and we're going to pay a premium for them. And Shamrock is classifying the investments as available for sale, and they use the effective interest method to amortize premiums and discounts. So the first question is, they are asking us for the face value, and that's simply that $80,000 that we're given. We need to calculate the selling price or carrying value when the bonds are issued, and it will be 5 for the number of periods. Our market interest rate is also that 5%. The payment is the par value, $80,000, times the 6% stated rate, for a total of $4,800. And of course, the $80,000 par value is entered as the future value, and we simply solve for that present value. So we get a carrying value of $83,464. We will receive that coupon payment of $4,800 every single period for the 6 years. And that's the 6% times the par value. Our interest is our 5% market interest rate multiplied by the carrying value, which begins at $83,464. The difference between the cash received and the interest revenue will be our amortized premium. And notice, this bond has a par value of $80,000. Its carrying value starts at $83,000, so the bond will be decreasing in value over time. The second year, again, we receive the $4,800. Our interest revenue is down a little bit because our carrying value has gone down. And of course, the amortized premium goes up a bit. And this happens year 3, year 4, and in year 5, where again, our carrying value will equal our par value. The journal entry record the purchase. So we're recording the purchase at the present value of those cash flows, the fair value, $83,464. Recall, we do not use premium and discounts for the asset side of debt investments. If this was a note payable or a bond payable, we use premiums and discounts and carry those notes and bonds at their par value. But debt investments, primarily because we're always recording them at fair value adjustments, we don't keep track in a separate account of that amortized premium or discount. And of course, we credit cash for the same $83,464. When we receive the first coupon payment, we're going to debit cash for $4,800. And again, our entries are coming off of each row of our amortization table as we go on. So we've got the $4,800 in cash. We're going to record $4,173 in interest revenue. And the difference is our plug to our debt investment of $627. And that's the decrease in our carrying value. But we have yet to adjust for any fair market value adjustments. Let's take a look at that now. We're told to assume our fair value adjustment account has a zero balance at 12/31/2020, and the bonds have a fair value of $81,000. Ooh, we're going to have to make an adjustment because right now we're carrying them at their book value of $82,837. So what do? We don't reduce directly the carrying value of the bonds. In other words, we don't reduce the debt investment. Instead, we use what's going to be a contra account in this case, because it's going against the value. we're going to credit our fair value adjustment and record an unrealized holding loss because our bonds have decreased in value by $1,000. $81,837. Again, that's simply the difference between our carrying value at the end of year one of $82,837 and what we're told is an $81,000 fair value. So that fair value adjustment will appear as a contra account and reduce the value of our bonds. And we're going to report them on the balance sheet at their fair value of $81,000. And that unrealized gain, notice the little equity in the parentheses, it becomes part of other comprehensive income.